Hello, this is Bob Steele. In this lecture, we will continue on Chapter 25, where we're talking about capital budgeting and managerial decision making. So we're going to talk now about accounting rate of return, which is another technique that can be used in order to help make decisions. So accounting rate of return would have the annual after-tax net income divided by the annual average investment. So this is another ratio that we could then use to compare types of capital investments. So if we're trying to invest our money in something, the question is, what types of investments should we put that in, and how should we compare different types of capital investments? This is one ratio that we could use, and in order to calculate this, we're going to have two ways to calculate the average annual investment. This average down here, one, we could say it is the beginning book value plus the ending book value divided by 2 in order to come up with that number. Or we can take the sum of the individual years' average book value and divide it by the number of years to get this average. And if we were to do this when coming up with the investment with similar lives and risk, a company will prefer the investment with the higher accounting rate of return. So of course, when we're comparing different projects, then the one that has a higher accounting rate of return would be the one that we would want on this method. Note that this method is not a cash flow method. It's based on accounting income, net income, which is on an accrual basis, rather than the cash basis that we were looking at in the prior calculation. So let's revise the $16,000 investment being considered by Fast Track. The new machine has an annual after-tax income of $2,100. Compute the accounting rate of return. Well, then we would take the average investment, and the average would be at the beginning, it's worth $16,000. At the end, it has a 0 book value. So then the 16 plus the 0 divided by 2 would give us our average there. So the accounting rate of return then would be $26.25%. Then we can compare that to other projects. So if we had another project, we would want the higher accounting rate of return, but note that we would also want to take into account other things such as the risk involved. So even if we have a higher accounting rate of return, it's still a question of, well, how much certainty is that rate of return giving us? Another thing to point out on the accounting rate of return is that it shouldn't be the only thing used, because it does have limitations, and those limitations being that they're not, once again, taking in the time value of money. So the next calculation will take in the time value of money. So once we've narrowed down our choices, we might want to do a larger type of analysis, which would be something like this. So accounting rate of return, an asset's net income may vary from year to year. The accounting rate of return ignores the time value of money. So these are a couple factors, which again, this would be a quick ratio that we could use. But once we get into the more detailed decisions, we might want to use something like the net present value. So what we're going to do on the net present value, once again, we're comparing capital investments. The net present value analysis applies the time value of money to future cash flows and cash outflows to manage, can evaluate a project benefit costs at a point in time. So we calculate the net present value by discounting the future net cash flows from the investment at the required rate of return, and then subtract the initial amount invested. So what we're going to do is we're going to see how much we think the future cash flows will be. Then we're going to present value those, because anytime we're talking about money in the future, there's a couple factors involved. One, there's inflation involved. We know that the time value of money goes down, and there's the opportunity cost of the money that we could have put somewhere else. Therefore, we're going to have to come up with this rate that we think that we need to get a return on our investment. And using that rate, we can then present value the cash flows in the future. So let's take a look at this. Net present value with equal cash flows. So Fast Track is considering purchasing a machine for $16,000 with an 8-year useful life and 0 salvage value that promises annual net cash flows of $4,100. Fast Track requires 12% annual return on the investment. So first question, where do they come up with this 12%? They're going to have to kind of figure that out. That's going to be an internal decision basically, and it's probably going to be based on what the best alternative would be, meaning if I put the money somewhere else, we could have got a 12% return. Therefore, we have to beat that return in order to accept something like this. Now, notice what we have here is even cash flow. So we're saying over 8 years, we're going to get an even cash flow coming in. Because of that, we could have used an annuity table, but we can get these numbers from the table, from a table, basically present valuing the numbers at 12%. So we're getting this information from a table to present value these numbers at the 12%. So that means that after 1 year, 4,100 in today's dollars at a discount rate of 12% is only worth the 3,661. The next year, the 4,1 on year 2 is going to be worth even less, and then so on and so forth. Year 3 worth even less, and so on. Then if we add up the present values of the 8 years, we come up to this 20,367. We subtract out the cost. That means that we have a positive present value. Now notice that in this calculation, anything that is positive, we would then accept based on the criteria of a 12% discount rate, because what we're saying is that we're present valuing this at 12%. So if this comes out to be 0, then it's still a good investment, because that means we got a return of 12% on it. Obviously, anything above that 0 threshold would be good, would be better. Anything that is negative, we wouldn't accept, because not because we got no return, but because we didn't get a return greater than the hurdle rate here of 12%. So net present value decision rules: when an asset expected future flow yield a positive net present value, when discount at the required rate of return the asset should be acquired. So when you do this calculation, just keep in mind that anything that is greater than 0 is accepted, because that means that it's clearing the hurdle rate, meaning we're getting a return equal or greater to the hurdle rate. So we're going to take the present value, we're going to present value the calculations, compare it to the actual amount we put in today's dollars, and if the net present value is positive, we accept it. If it's negative, we reject it. If we're comparing different projects, we're going to take the one with the higher net present value.